One of the important things that's really driving what we're seeing in the markets today is just pure and simple the demand forecast. This demand forecast for electricity, generally in the past, Jack mentioned I've been in the business a long time. We always used an estimate of 1% increase a year in electricity demand. That's really changed in the last couple of years with the advent of not only data centers coming online, but increased domestic manufacturing and also EV vehicles. The need for power is really like we've never seen it before in a long, long time. So the projections are also exactly that. They're just projections. There's not a known amount of electricity that's going to be needed. There's a range, and that can, complicate infrastructure build out, policy decisions, and influence pricing along the way. So what we'd like to cover today is what is the infrastructure growth that's happening to address this change in forecast on the near term and then the short term. And then later in the presentation, I'll get into some pricing scenarios and close out with any questions you may have. The challenge right now is that load, if we look at the bottom of the chart here with, for example, data centers, load can connect and build onto the grid between 2 to 3 years, essentially, pretty quickly. And that load is very strong load. It's not a small amount, it's a decent amount. In response to that, the generation or development of transmission lines takes a much longer period. So there is a disconnect. If we look at transmission, if we need to build a transmission line to satisfy the needs of this demand, it can take up to 10, 11 years to do that. In lieu of building a transmission line to get power from A to B, we could build a power plant at location B. Okay, well, let's look at how long it takes to build a power plant. At best, if we're looking at a synchronous generator, which is one that generates power that synchronizes with the grid, essentially, that can take up to 6 years to build, but for like hydropower and 5 years for thermal power. That I think is aggressive even. There is a number of reasons why it's taking longer than it used to. It used to be we could do it in 3 years, but there have been a lot of supply chain disruptions. There's a lot of demand for turbines, and just general financing of these projects is taking a little bit longer than expected. And then finally, when we look at kind of renewable generation, those can get online a little bit quicker if we're talking about batteries, which is that last kind of bubble there in the inverted based sources. But it can also take super long, like wind. So the general theme here is that load is coming on faster than we could build generation or build transmission infrastructure. And that disconnect is showing up in price volatility and really a change in policy and potentially market structures going forward. If we look at generation, this graph shows all the ISOs, which are independent system operators. They are geographically located, and they're kind of like what I would call like the traffic cops or air traffic controllers of the electric grid. They dispatch generation from the most expensive to the least expensive every hour to satisfy the load or demand on that hour. Each of these ISOs have a different buckets of how they produce electricity. In general, it's what fuel is available at that geographic location. So for example, the first bar here is California. It's called Cal ISO. They have a significant amount of solar compared to all the other ISOs, and for obvious reasons. In PJM, where I live, there's much less solar available, but more natural gas because we're sitting on, the Marcellus and Utica shale plays. So you can kind of see the distribution or of fuel types within these ISOs. And then looking into the future of what is being interconnected at the end of this year in 2027, we can see that ERCOT, which is Texas, is really going strong with new generation. Up to 50% of their current portfolio is going to be new generation interconnected. And a lot of that is going to be solar, batteries, and a bit of natural gas. So all the ISOs recognize they're in this situation where they got to get generation on really quickly. The last piece I want to say on this, it's kind of a detail, but it's an important detail, is this graph represents what we call nameplate capacity, which is how much can that generation source produce at its peak. That can be very varied depending on the source. So for example, a 1 megawatt peak of solar can't produce at 1 megawatt every hour because the sun don't shine in the nighttime, right? So it's only producing about half of what the same type of setup for natural gas. Natural gas can produce at a flat rate. So that's just a distinction on this graph that this is nameplate capacity, not necessarily what will be generated on a kilowatt hour basis. So one of the other things that is kind of creating some challenges when trying to get generation online quickly is that we are seeing wind generation come into some challenges with the current administration. A lot of projects, about 12 projects, have been canceled for wind generation. Some of those are offshore on federal land, and some are onshore on private land. And it's one of those things where it's kind of death by a thousand cuts. It's not that the administration goes, we're not allowing this anymore, but it is, kind of delays in permitting, reduction of tax credits, any sort of, interference or delays that the federal agencies can do at this time is probably being experienced by these types of projects. Some good news is that New England, specifically New York, has brought online a giant transmission project. Really about 9% of the annual ISO New England consumption is connects Maine to New York. So this is really great for New York. It's going to satisfy about 7% of the annual load down in New York ISO, specifically New York City. So this is a nice project that is bringing more of that kind of cheap hydropower down into the New York region. And LNG exports. Let's talk. This is a biggie. LNG, I'll just give you a kind of a high level. This is natural gas that is piped to terminals, mostly in Texas and Louisiana is where they're located. There's a couple terminals out in the Northeast and in Alaska. But generally speaking, Texas, Louisiana, these terminals take natural gas and freeze it to a liquid state. Then they put that liquid state gas into big tankers. They almost look like crucibles hanging on a shipping ship, and take those into other markets such as Japan and Europe. the price spread between natural gas in the United States and the European and Japanese markets is about $10 a decatherm. And if we think about that, it's kind of mind-blowing to think about that. But our gas, we'll just call it $3 to $4 gas. They're paying $14 to $16 gas. So you better bet we are exporting as much LNG as those terminals can handle. And the bottom right graph shows the actual exports in relation to the capacity that's available. And we are, right bumping up on that available capacity each month. We just had the largest exports ever last month at 18 BCF a day, which is about 15% of our overall production. And that's going to continue to grow. As you look at that bottom right-hand graph, the capacity being built at these LNG terminals is expanding rapidly. Again, we're at about 18 BCF a day of export capabilities. By 2031, that's expected to be up to 47. Gigantic demand. And that's going to influence our prices here at home. The good news is we're sitting on a bunch of natural gas with the shale regions of Texas and up in Marcellus Utica shale plays. And it's just how do we get that gas to these terminals? And this is how we're going to do it and are doing it. There are numerous pipeline construction projects happening right now that have in-service dates of this year and next year to support LNG exports. It's all that bottom quadrant of this table. If we were to add up all these projects in MCF per day, it's basically converting that to BCF, 36 BCF a day for all these projects, 30 of which are going to go to support LNG exports. The other projects are smaller in nature, bringing production to market, expanding regional gas access, and in some cases directly supporting data centers where they are building their own gas-fired generation. So this is, from a gas demand standpoint, this is big. LNG making up what could potentially be, 30 to 40% of our entire production. So what's happening in the producing regions? Are we going to produce more? And the answer is yes. If we just look at the Permian, which is Texas, Oklahoma, we can see that pipeline capacity is increasing. And right now, we're sitting at around 40 BCF a day of existing pipeline capacity. They're going to build that up. The expectations are around 65 by 2030. So all of these are kind of going in lockstep. And as much gas as we have available in these regions, it's not that we don't have gas. It's there. It's just getting the pipeline capacity built to get it out of the ground. And most of these regions have, let me see if I have a slide on that. Yes, most of this production can be done or extracted out of the ground for less than $4 a decatherm. So if you remember, I kind of said earlier, our price of gas is between $3 and $4. That tracks with this. And that the export markets are, $14, $15, $16. That's going to just continue to encourage production. And as you can see kind of from the green bars on this graph, most of that production is coming in very cheap. So I'm going to backtrack real quick because I wanted to flip to that slide. Those are kind of the big gas production and supply um, fundamentals, we're going to see more power plants come online. A lot of those power plants are going to be burning natural gas, as well as, it's kind of a all above card where we're going to have renewables. We're also going to have natural gas and storage as well. So what are some other newsworthy items? We know we have this geopolitical influence with the Strait of Hormuz. It's been well documented that 20% of our oil and 20% of the LNG, when I say our oil, I mean globally, um, come through the Straits of Hormuz. That's going to really affect global prices, but we have been insulated from that. And the reason is because we are self-producing our own LNG. We have our own gas. We're exporting into these markets. We are not importing LNG, which if we were, that would be problematic and we would suffer those price increases. In the New England markets, there is a portion because they are kind of end of pipe of the natural gas pipes that could be affected by LNG price spikes. But in general, from an energy standpoint, we're insulated from what's happening over in Iran. Where we will feel it likely is that more of this long-term recession that could happen given all the other implications of fertilizer and things like that. Another piece is El Nino. El Nino is a weather phenomena where the Pacific Ocean waters are warmer than normal. And what ends up happening is when the trade winds hit that warmer bucket of water, it develops into a wetter and potentially warmer, more humid summer for the states. So that could influence short-term pricing here for this summer if temperatures are above what is typical in the regions. And then finally, this RGGI, which is Regional Greenhouse Gas Initiative. This is an initiative that really puts, in simple terms, a carbon tax on power generation that emits CO2. And a lot of the New England states, mostly, Maine, Delaware, New Jersey, Maryland, New York, have participated in this program where there is a premium placed on any generation that's emitting CO2. Virginia was in, then they were out, and now they're back in. And this is important because it increases pricing by about $10 per megawatt for many of these regions. Again, it is a tax. Well, I'll call it a tax, but it's an added layer of cost driven by policy decisions that increases the prices for everybody. $10 a megawatt hour assumes a gas-fired power plant. If it is a coal-fired power plant, the premium is around $20. So there is a a dispatch stack, and what will occur is lower cost units will be dispatched as they move up the stack, and as you move up into coal pricing, this added level of cost then kind of pushes it out of the dispatch stack because it's much more expensive to run. Gas production we talked about. And so when we look at pricing, what has the average of Henry Hub, which is the trading location in Louisiana where the NYMEX contracts settle? What has that price point done historically, and what does it look like in the future? And you can see through the volatility here of historic hub pricing. Much of that is driven by weather or geopolitical events. So 2022, this big spike is the Russia invasion of Ukraine. We can see most recently, this 2026 pop was Winter Storm Fern. And throughout the history, we've had these numerous, weather events that, or geopolitical events that make things pop. What you can see here that, or I guess you don't see, is any pop due to the war in Iran. And again, that is because we are really insulated from those prices since we're a producing region. The long-term forward market is this kind of teal, and it is a cyclical or seasonal market. So these peaks are during the winter time when gas is used mostly. But if we look at what's the trend of the forward market, what do traders think is going to happen out in 2032 for natural gas? And really, it's flat. So even with all this demand that I talked about through LNG exports, the market believes that production can keep up with that type of demand at rates that we see today. So how does that translate to electric? And I know this is a busy graph, but I think it's worth talking about. I have a number of ISOs graphed on this graph here, and each one represents a 1-year continuous strip. So if I were to buy power today for 1 year tomorrow, what would that look like? And this is a plot of where that 1-year continuous strip has traded over time since April of last year, or excuse me, 2 years ago. So we have PJM, ERCOT, MISO, California, and SPP plotted on this graph. My takeaways from this are, and if you grab one line of wherever you're located and kind of follow it through time, is we've seen it's really been range bound. We've not seen a continual increase. We see some bumping and off the top and off the bottom, but really been range bound for each of these ISOs of around $10 to $20 per megawatt hour. There is a premium right now in the PJM market. It's the highest market out of all these ISOs, trading at $52 for the forward strip, which is something counterintuitive, California, which is trading at $34. So a pretty significant spread between those two, and that's just the energy component. There are other components that make up your electricity bill. Some of those things are state driven, which in California, there are renewable standards that will increase this price. But from a pure wholesale electricity view, it is a discount to where we're trading out in PJM. So given all this kind of uncertainty, excuse me, didn't go here. As if I were sitting in your position looking at how should I react to some of these prices, I think the expectation is it's going to be extremely volatile for the next 5 years. And I say that because we have this mismatch in timing on load coming online and generation. We have markets such as PJM, they just came out with a paper saying we may need to redesign the entire market because our assumptions in the past no longer apply to this future state of energy. And so they may be looking at redesigning the capacity market in that ISO and the energy markets to better align with what's going on in the market with how do we get generation online quickly and how do we ensure the finance behind those generators a revenue stream that can get those projects underwritten. Between now and the next 5 years, it is going to be choppy. And I would, if there's any time to align with an expert, whoever that may be, kind of now is the time to do that. There are, as I mentioned, commodity volatility, there's going to be policy volatility, and there's going to be technology volatility. And at the end of the day, you want to be protected, and aligning yourself with somebody that kind of stays on their toes in these matters will be helpful. With that, I'm going to stop there because I think we only have a few minutes or a minute if anybody has any questions.
Thank you for those insights, Suzanne. Really interesting to see how demand in some cases is diverging with capacity generation right now. So we'll continue to see how those dynamics evolve in the coming months. But as you mentioned, keeping a close eye on energy markets, particularly as we head into the summer months, no better time for it. We'll leave a brief moment if any participants or would like to ask a question. Um, have that opportunity now. And I'll go ahead and ask a question. As we do head into the summer months, Suzanne, and we start to see um, more dynamics around energy needs within the facility, how can manufacturing energy buyers consider their energy strategy as we're heading into a high demand month period?
That's a great question. I think one of the most important things is alignment within your company on risk. Sometimes the buyer of energy is kind of an island on their own, and they make decisions on what they believe is the best for their company, but then things may hit the fan and suddenly it becomes in the CFO's radar. And what I would encourage all of everybody on this call is to just make sure if you're in charge of energy, that your C-suite is aligned with the strategy, whatever that strategy may be. To protect yourself, you may want to take some forward positions to lock in rates, even if it's 50%. If you typically ride the market 100%, I would encourage you to look at some longer term positions to not for all, but a portion of your load just to protect that price spiking that could occur. But the bottom line is nobody wants to be called into the CFO's office when things go wrong, and to make sure that the team understands that we're all in alignment.
Full alignment. Good thoughts to close our webinar with. And now that we have come to our time, we thank you all for attending the May session of the NAM Energy Pulse webinar. As mentioned at the top of the webinar, slides will be emailed out within 24 hours of the commencement of this webinar. But again, thank you, good afternoon, and we look forward to seeing you for our next webinar in June. Thank you.
Thank you. Appreciate the time.